C.S. Vaidyanathan, who is also the Vice President of Bar Association of India. We also have Mr. Prashant Kumar, President BAI, and Ms. Lisa, President Law Society of Singapore, Mr. Rodden, who is on the dais, President Law Society of Hong Kong. Catherine will be joining us on online mode, and we also have Divino, President Bar Association of Seychelles. Over to you, sir.
Good afternoon. I know a number of people are still having lunch and then trying to join. I think we should get the session going because it was scheduled to start at 2. We are starting at 2:15, so we should start. We have a very eminent panel of distinguished persons, and what I find is they all have domain expertise on the subject of the session for this afternoon. And I am as eager as all of you are to listen to them, so I don't want to take up more of time. But I just want to say something about what's happening in today. You know, the fundamental premise of the subject of the session is rule-based order. That had been assiduously built up over the last 80 years, at least, post Second World War. And that's lying in shambles today. International institutions, whatever they say is hardly listened to by persons who claim to be the policeman for the world. Nobody imagined this kind of a situation. Nobody thought that the largest democracy will be described by somebody who is supposed to be close to the president of one of the leading countries of the world as a money launderer, a country being described as a money launderer. This is a very, very unfortunate situation. Ironically, that is a country which is legitimizing cryptocurrency, which can easily turn laundered money. We are going through rough times, but this shall pass. We have to wait for glad tidings, and it should happen soon. I don't want to take any more of your time. We now turn to the first expert panelist. Our President of the Bar Association will be speaking first. He doesn't need any introduction, all of you know him. I shall certainly have brief introduction for all the other panelists, but Prashant Kumar doesn't certainly need any introduction. Over to you, Prashant.
Thank you, friends, for being back after a quick lunch. Others are trickling through, but we think we should not hold back the proceedings. Friends, essentially, the frameworks which have been built for anti-money laundering and Financial Action Task Force, or FATF, are frameworks to protect the rule of law. In the previous session, we talked about cross-border terrorism that cannot exist without money being available through channels which are able to fund such activities. even otherwise, other international issues of high concern in the sphere of human rights and the rule of law are drug trafficking, human trafficking, and even trafficking of nuclear technology, other technologies which operate under restricted frameworks and, if are not in safe hands, can spell a doom globally. So that's why the anti-money laundering regulations and FATF framework, which helps to implement it, are very essential tools of the international economic governance. What we are discussing here is whether the tools which ostensibly are there to shield and protect and promote the rule of law and human rights can have other aspects also, which can at the same time have potential to undermine these very values. And that is where it is not just the economists, it is not just the policy makers, it is not merely the financial experts on whose hands such activity should lie. Legal professionals who are naturally trained and have as part of their professional domain protection and promotion of rule of law and creating legal and regulatory frameworks, those who are cognizant of these values must participate and be engaged in a manner that protects the other values as well. This thought came to me while devising this topic when I was dealing with certain jurisdictions in Africa who depend on generic drugs from India, which are procured through World Bank procurement channels to safeguard their populations from disease, from endemic disease, and for treatments which, in the absence of availability of cheap drugs, is a direct assault on the minimum right to life, because if a cure exists and it is available but not affordable, is a travesty and it undermines human rights. So what happens? Not all countries in the world have equally strong financial systems. So when we build frameworks to prevent money laundering, like Know Your Customer, and we have other group of recommendations like 40 recommendations created by FATF, we must see what are the implications for this for the countries, communities and populations who are already underfinanced, who are already underbanked, and who are still struggling to get into the financial inclusion space. Whether these regulations help to push them in or to push them further out is the situation we wish to highlight here. So talking of the medicines, I discovered that some medicines like even metformin, which is a basic drug for diabetes, if it is available in India for a month's treatment, for less than $1, the same manufactured in India is available to a poor person in another country for $25. How this $1 becomes $25? There are many reasons for it, including the commercial reasons, but then this procurement is also part of the World Bank funded initiatives. So, how does this huge markup exist? So, looking deeply into it, one of the problems we found was that most of the small countries with small banks and local currencies, not convertible, then ultimately depending on international convertible currencies, could transact business, because when you import something, you have to provide payment, you have to provide some kind of financial instrument in terms of bank guarantee, you have to provide an instrument in terms of letter of credit, based on which the import can be done. But what happened? There were instances in which the reasons were different, but large international banks, multinational banks, which were providing a mechanism that is called the correspondent bank mechanism, by which a small bank can transact internationally through a large international correspondent bank to make these transactions. The letter of credit and bank guarantees are backed by those instruments, and that's what made the whole transaction more financially viable and efficient and cost effective. But when the AML regulations kicked in, some big banks in Europe were faced with huge penalties by Security and Exchange Commission of United States, running into billions of dollars, because the lapses in AML were found to be quite significant. But having penalties to address them and not push for, in the equal measure, the structures which will oversee and the principles which are to be implemented. So, what happened? Couple of huge multi-billion dollars penalties sent shockwaves and panic into financial sector and the banking sector. As a result, the banks, apart from gearing up for implementing these regulations, started de-risking the operations at a lower cost and effort. So, one of the risk areas was, okay, we can do the KYC. How can we vouch for a small bank in Africa or Asia which is doing these transactions through us, that their lapses will not hit us? So, instead of addressing that and creating a framework, or also demanding internationally that this is the situation which can bring problems to our doorsteps, so you have to give some kind of concession, you have to give some kind of time frames to implement these, because banks work on commercial logic, they simply started terminating these relationships. And what happened? The result was that the smaller banks in countries, and sometimes countries as a whole, were left out of the financial transaction network through this device. which means they had to depend on third-party contractors and suppliers, which led to multiple markup on the essentials like medicine, foods and all, the availability of which and affordability of which is a core human rights and rule of law concern. There have been efforts of late to address this, and we will have a speaker from Basel Institute of Governance, Switzerland, Katerina, who will be making a video presentation to us today, and she advises on FATF framework and AML frameworks to governments and to big clients and helps develop these frameworks. But we thought that it will be very important that as law societies, bar associations, we are confronted this situation within the profession also, where there are reporting obligations to prevent money laundering, which can be onerous, which can have stress on client confidentiality issues. And so that also requires a discussion, because ultimately if lawyers are not able to work having full confidence of their clients, and unless until they are an accessory to the crime of money laundering, what advice they give, what services they provide should be out of the reach of any authorities. That is how the independent professions work and achieve their objectives within the hierarchy of rule of law. So I think these aspects need a deeper deliberation, and in this convention we are bringing these issues to the table so that we can apply our minds collectively to find appropriate solutions, and as bar associations create policy briefs, advocacy briefs for our own governments and for international bodies. Thank you very much.
Thank you, Prashant. Our president has thrown up a lot of issues which need to be addressed by the fellow panelists and by all of you. I would now request Ms. Lisa Sami Min, who is the president of the Law Society of Singapore, to address you. She is a barrister at law in England and Wales from 1997. She practices in Singapore from 2004. She has also been a mediator and has a deep interest in sports and in management of sports association. She has also been an independent director of Stock Exchange of Singapore and has deep experience in the subject that we are talking about. Over to you, Lisa.
This is rodent.
Your presentation, yeah.
Wrong one. Wrong one.
This one, no? This one. No, sorry.
Lisa.
I just go
Looks a bit like that.
Just go and
We are just taking a minute to have the presentation uploaded.
Send the phone. Wait, have you get my phone? Is it okay? I get my phone?
Yeah.
Lisa, can we, if we just take a couple of minutes, can we switch?
Friends, there is a slight change. Instead of Ms. Lisa Sami Min, we are going to have the video presentation by Ms. Katerina Boguslavska. She's already logged in and ready, and she has extensive practice in the domain that we are discussing in regard to financial crime risk, money laundering, and therefore her address will perhaps raise various issues and present points of view which can be the basis for further discussion. Please go ahead.
Thank you very much. I hope you can hear me well. My warmest welcome to all of you, and apologies that I cannot be present in person. I am currently connected from Vienna just after the conference on measuring effectiveness of anti-corruption body. So it's topic close to what we are discussing, but from the other side of the problem. I am glad to share my presentation. I hope it works well. Yeah, you can hear, you can see it, right? Okay, so I want to address several of issues that were already mentioned in the introduction, and thank you for that. And my approach will be, again, looking at where are we standing and what are the backgrounds. So it was already mentioned a lot about FATF and FATF global standards, but the main thing about is a risk-based approach. Clearly, FATF gives its understanding of the risk through the latest one, through 3 different components: threats, vulnerabilities, and consequences. So by assigning a high risk to some type of client, to some type of jurisdiction, we have to look specifically at these 3 components. It might sound easy, but let's confirm that it might be easy when we want to calculate credit risk for someone, but it's not that easy when we want to calculate financial crime risk. So initially, we are at the process when we are to apply the risk-based approach, but the understanding of risk within certain sectors, within certain type of clients might differ. And that is one of the first complexity that we have. While applying risk-based approach, there are clearly 3 levels that FATF is using, but in recent years, the most of its focus was on high risk. So high risk jurisdiction, high risks, understanding of high risks, and what it brings to us a lot of unresolved issues. Okay, we can identify something as a high risk type of client or high risk jurisdiction, but it might cause us to end with financial exclusion of the total type of clients or certain countries. So while before in the FATF documents, the first and most important aim of the work that FATF doing was to protect financial integrity, since last several years, the approach focused not only to protect financial integrity, but also to ensure financial inclusion. Clearly, it's a difficult task to do if we look only at a high risk, so the approach should be more differentiated. The other things which turn out to be really critical while applying risk-based approach is Where is this measure where we have data privacy and data sharing? Clearly, it's a lot of standards for international cooperation, including informal cooperation. And from the other side, we have strong standards for banks on keeping data privacy. The other third topic, which is also coming from the application of risk-based approach, is a certain gap between how it is written in the global FATF standards, especially on supervision, and how it is done in local practices. Clearly, that local practices are less based on risk-based approach, more based on rule-based approach, and this forces the obliged entity to do over-compliance because of the demands of their local supervisors and local regulators. All that is not topics that FATF wanted to hide. It is quite positive that they are open to the discussion, and they're working on that. And I want to demonstrate you certain progress that have been made, and it's specifically on approaching what is a low risk. So from addressing only the high risk, we are coming to other side, what is a low or lower risk as it is in FATF. It comes through the better understanding of the financial inclusion. And while in 2012, it was just one of the may allow certain products or certain sectors to be identified as a lower risk. Now in 2025, we are at the stage that countries should allow and give the reasoning why they allow in simplified measures or east exemption criteria. It's a huge gap, even though it is not clear how much reasoning is expected from the country or from the sector to provide to support the sectors that are opt for simplified measures or the type of clients. So the work is still in progress, but there is certain dynamic to say that we are moving not only from high-risk countries, high-risk clients, but actually at looking what we should see as a lower risk or lower risk client. And this is a very critical approach that FATF will push through the next round of evaluation that already started, the 5th round of evaluation. Before going further, I wanted to share with you some data that we analyzed for the Basel AML index to see actually, do we have any progress with these global standards and where do we stand? Clearly, and there the point was to analyze the 4th round of evaluation that currently is over and to look at the perspective of 10, 11 years where it started. So the progress, most of all, we can see in technical compliance, and that is already to be celebrated. So these 40 technical compliance recommendations, we see the progress in 12%, and currently is around 65% average globally in technical compliance, meaning that most of countries managed in certain way to implement recommendation of FATF related to their legal background, the infrastructure, the legal infrastructure in the country. When we look at the other side on effectiveness, because that's where probably we expect the most of the results to be seen. So how this legal infrastructure is implemented in the country-specific background, we see that effectiveness is still low at the 28%. Perhaps it's because we are doing over-compliance and trying to reach highest level in terms of technical regulations. And we then don't have enough time or enough resources to work on our effectiveness. The costs of these results are really high, and as it was estimated, only financial institutions spent around 206 billions of dollars globally on AML compliance. Whether it is effective, we saw the score for effectiveness. We still see that illicit assets continue to flow and confiscation rates are still very low. What would be one of the results of application of these standards? When we look at the question why it is so, one of the key, to my opinion, reason would be that we are too much concentrated on technical compliance with the standard. We are less concentrating on understanding our risk specific to our client or risk specific to the sector. Thus, we, instead of layering our risk approach through medium, lower, or high, we prefer to treat everyone as high, or most of that as high, due to the obligation from the local supervisors, local regulators, or simply by being on the defensive side, because then we are able to prove that we did enough. What might be the step back is to try to look at more complex picture. And there where I would shortly give you an overview of the Basel AML index, because we are trying to see the risks in complex picture, not only through the legal framework of the AML in the country, but certainly also looking at such domains as corruption, fraud, poor financial transparency and standard, poor public transparency and accountability, and what is also important, weak political rights and rule of law in the country. We have several these domains. They are according to the weighting system that is presented here, but we have 17 indicators and 9 sanction regimes that help us to build the country picture, starting from the FATF data that we have, ending up with how independent is judiciary in the country and what is the level of rule of law in the country. I will show you the full number of indicators in this table just to emphasize several observations. Certainly, there is a high correlation between predicate offenses of human trafficking, narcotic trafficking, corruption, and the shortfalls in the AML CFT framework in the country. But less what we would expect, we saw that sometimes countries in their scores in FATF, specifically on the quality of supervision or on the quality of financial intelligence unit or on the quality of terrorist financing, showing very high level of their compliance and effectiveness while having low scores in terms of independence of their judiciary and low scores in terms of rule of law. That's why we should go a step further than just looking at the standards without having the full picture. The full picture is helping us basically to see all underlying 17 indicators, and the data that you see, it helps you to understand not only the shortfalls in the FATF mutual evaluation report and follow-up reports, but also other data that will either support this or give you a different perspective to look at it. We do this within the Basel Institute on Governance and International Center for Asset Recovery. We publish this data annually on our website, as well as on subscription-based. And it helps us to look more at not how to be compliant with FATF standards and recommendations, but how to assess wider financial crime risks, a wider approach, and how to control for such important things in the country as media freedom, rule of law, civil and political rights, and independence of judiciary. Because out of that, being perfect in FATF assessment doesn't tell the full story. As I said, we also have a sanction regime, different dashboards, data formats, so it's all available. Clearly, as anything else, we have limitations. Clearly that it's difficult to assign risk score where I started to something that is difficult to calculate. We have some perception-based indicators, not all of that, but there are the limitations and we are open about that. To finalize, I want to say that we should not diminish the results that countries already achieved globally, specifically in terms of technical compliance and implementation of the standards in their legal framework, but we should go further, looking at effectiveness and looking at the more complex picture that will probably help us to move from over-compliance to better understanding of financial crime risks per country and better mitigate to and allow us to have better mitigating measures. Thank you for your attention.
Thank you, Ms. Katrina. I think that was a very detailed presentation of risk assessment and risk management by the Basel Institute of Governance, and I think it will help us to understand the problems which are being faced by the banks, financial institutions, and institutions of governance. May I now request Ms. Lisa to make a presentation. May I request all the other three panelists to limit themselves to about 8 to 10 minutes, please. Thank you.
Thank you. Good afternoon, everyone. Okay, I would just cover very briefly about the topic, anti-money laundering regulations and the FATF, which we pronounce as in Singapore as FATF framework, and the challenges of over-compliance and financial exclusion in the global south. Because it's rather technical, I will just briefly touch on the framework and regulations. Okay, so the Financial Action Task Force FATF framework is established in 1989 by the G7 countries, and it launched its framework in 1990 with the first 40 recommendations that set global standards to combat money laundering, terrorist financing, and proliferation financing. Oops, sorry. Do I point here or point there or point? Okay, I don't use the clicker. Okay, so what is a FATF framework? A FATF framework incorporates the recommendations and it outlines measures countries should implement to combat money laundering, terrorist financing, and proliferation financing. So due to the diversity of national legal systems, the FATF recommendations offer unified standards that countries can adapt and fit their legal and institutional frameworks. So to support this, the FATF has developed a risk-based approach allowing countries to adopt flexible measures within its framework. This enables more effective allocation of resources based on identified risk. So first, the country has to identify your own risk, and then you allocate your resources how to tackle that risk. This risk-based approach under FATF guidance requires the authorities, lawyers, notaries, and other legal professionals to identify, assess, and understand the risk that they are exposed to. So as a result, lawyers have to now invest in resources and training to understand and manage money laundering and terrorist financing risk relating to their services, their clients, jurisdictions, and existing controls. The core idea of a risk-based approach, which is RBA, is to allow each country to adopt a more flexible set of measures to target their resources more effectively and apply preventive measures that is commensurate with the nature of the risk, so that so that they can focus their efforts. So it's not to stamp out everything, but you are supposed to measure your risk and tailor it accordingly. The RBA framework, basically, if you look at the top line, so first you go with risk identification and assessment. So you got to assess for yourself. Like in Singapore, it was assessed that lawyers who do convincing work tend to be the large proportion of people where money laundering tends to find its way in their transactions. After you have identified and assessed, you have a risk management and mitigation consideration, and that's where you apply your measures, and then you have ongoing monitoring. You put policies and procedures and information systems in place in your firm, in the transactions that you do. And most importantly, also documentation. You have to document your risk assessment. So for instance, if you find that this client, you're not quite sure whether or not he is 100% suspicious, and you feel that it is appropriate to continue to act for the client, notwithstanding in some jurisdiction, you can file a suspicious transaction report. You must document the risk assessment. Your firm must have a strategy, and you must have a policy and procedures in place to monitor and manage and mitigate this risk, because the client can give you additional information that will either ease that suspicion or increase your suspicion such that you will take other drastic steps. So, so the challenges of overcompliance and financial exclusion in the Global South. So any country below the red line are considered Global South. Those above the red line are, generally speaking, the G7 countries. And it's defined in the Cambridge Dictionary and World Population 2025 as some of these countries. So what is overcompliance? Overcompliance is, I think the earlier speaker said, rules-based, applying an overly cautious, non-proportionate AML. This is CFT, means countering financial terrorism, financing terrorism safeguards when providing financial services. Okay, what happens is that you can exclude legitimate consumers and entities from a financial system, and these entities will end up being underserved and also causing an increased cost of their access to these financial services. So when these individuals and entities lack access to financial products and services to meet their basic financial needs, they are forced to resort to cash and unregulated channels, which then undermines the purpose of the whole FATF regime and framework, because it actually ends up increasing the risk of crime. Okay, and that is known as financial exclusion. Okay, so what is the definition of financial exclusion in the FATF guidelines 2025, which is just recently given this year, is that when individuals and entire groups are unable to access formal financial services such as banking, credit, insurance, and this is typically for marginalized, low-income, remote, undocumented populations in the Global South. And because these populations are underserved, they may have to access money or value transfer service provider, but they are not a bank. And this individual is actually given more barriers because they have no means of meeting the documentary requirements. And this strict documentary requirements, say for opening of an account, can exclude workers active in rural areas or informal economy who are less likely to have wage slips, formal proof of domicile. So FATF's requirements is to recognize the impact of financial exclusion and consistently emphasize that the practice is not in line with the risk-based approach. So sometimes when countries implement, they look at the rules and they think of the solutions, but they are not addressing the financial exclusion impact on any individual or entity. So in 2014, FATF issued a statement clarifying that the wholesale cutting loose of an entire class of customers without taking into account their level of risk is actually contrary to the risk-based approach. So what is financial inclusion then? Okay, financial inclusion means that there is a goal to design the measures to beat without compromising the purpose of combating crime. So for instance, some financial inclusion requires both the government and individuals to access active use of adequate suite of regulated, appropriate, safe, convenient, and affordable financial services by individuals, including households, and that these entities would benefit from such services. Okay, and there is also a tendency to have the wrong assumption that people who are underserved or undeserving people who are excluded from the financial schemes, and they are actually less of a risk, and that is actually not necessarily true. So in Singapore, for example, in our Monetary Authority of Singapore, MAS, we developed and enhanced financial inclusion for high-risk individuals. So these are ex-offenders who were involved in serious financial crimes. So they were allowed to open bank accounts to support basic banking needs, like for their salaries, the bills, government payouts, and an enhanced monitoring was placed to allow funds to be paid into their account from pre-approved sources. Oops, sorry. And any bank who refuses to open an account for the individual must justify their decision, and there must be clear communication required for rejections or closures, and there must be an appeal process with the contact details given by the bank for any rejection. Okay, so this is an example. So over-compliance and de-risking is a situation where financial institutions de-risk, as what President Prashant had said, by cutting off entire client groups to avoid penalties. So this has the impact of affecting entire sectors like NGOs, remittance providers, and small businesses. And lower income migrant workers and the disadvantaged are pushed into informal channels, increasing cost and security risk. So, so there is some limitation in the FATF framework. It was launched in 1990 and generally drafted more applicable for the global north priorities at that time. And the standards were shaped by US, UK working needs and not necessarily aligned with the needs of the global south. So the developing countries now face growing compliance burdens limited by the relevance to local realities. So, but then, as I said earlier, for a FATF framework, right, it is not meant to stamp out all kinds of financing, because trillions of illicit funds are still moving through the global system. Is with proper framework in place that are appropriate and moderated, they have limited avenues or slightly less limited avenue currently to move these illicit funds through the global system. So there is a lot of pressure given because there is a grey list which results in countries or Monetary Authority of Singapore, for instance, fostering over-compliance. So banks tend to have a knee-jerk reaction to respond with a zero-tolerance policy, and they prioritize safety over fairness, and that is what we know as systemic exclusion, especially in the global south. There are some collateral purposes that come about. So sometimes there is politicization of FATF. So some authorities can use FATF to silence critics, lawyers, and journalists. And there is also a civil asset forfeiture methods that unfortunately bypass due process required under criminal law and weaken legal safeguards with a lower burden of proof, because you can seize these illicit assets and is usually retained by the government. So sometimes regulatory measures may reflect geopolitical interests rather than purely technical standards. So, and developmental costs for the global south. So these are the various difficulties. So I think you can read for yourself, just to go faster. And I think there may be some need to reform. I think it was confirmed by the earlier speaker that we need to contextualize AML standards to ensure that they are proportionate, socially relevant, and do not penalize lawful activity or marginalized groups. I think inclusion must go alongside with the regulatory framework, so you must create something for a certain group of people, at the same time require them to comply with certain FATF requirements. There should be greater representation of the people of Global South. And there is also the other end of the spectrum where people who are sophisticated have got no problems with giving documentation. So you have people generating invoicing like trans-country invoicing, trade misinvoicing, tax avoidance. So the better method is to obtain and adopt a balanced evaluation matrix that measures both compliance and financial inclusion. So what is the role of the lawyer? We should advocate for proportionate regulation that protects the innocent and promote fairness, support NGOs and civic actors against misuse of AML rules for political repression, call for greater transparency and accountability for FATF's decision-making processes, and, as I said, promote the integration and inclusion with compliance matrix, and defend due process and challenge legal tools like civil asset forfeiture that undermines legal safeguards. Okay, so I would just talk very briefly, very quickly about in Singapore, our experience as a legal profession was that there was a requirement earlier that has been amended last month that whenever you file a suspicious transaction report, you must discharge yourself as a solicitor acting on the matter. That gave a lot of difficulty for Singapore lawyers because you can be in double jeopardy. You can end up getting into professional difficulties with your client because they'll file a complaint against you, and yet you are not allowed to tell the client that you have filed a suspicious transaction report because that's tipping them off. So lawyers were between a rock and a hard place and had to find a way to discharge themselves without bringing up why they really wanted to discharge themselves. So that is something I think we should avoid. So in July, there were amendments to our statute to say that you can continue to act for the client if you file a suspicious transaction report, but you must do enhanced monitoring and you must document your reasons why you still take the view that you can continue to act for the client. Then, of course, you should think about discharge if more evidence comes out. So this is just one of the experience that we have. Thank you.
Thank you. Thank you, Lisa. Lisa has touched upon some of the pertinent issues in regard to informal economy in the global south and developing countries, and the politicization and the risk involved, including curbing certain freedoms of lawyers, opposition politicians, and also the systemic exclusion therefore, these are some of the issues which are relevant from the Indian perspective also and from a number of countries in the global south. I would now request Mr. Divino Sabino, the President of Bar Association of Seychelles, who apart from his experience in this area and in law, also advises persons in regard to investment in real estate in Seychelles.
Good afternoon, distinguished guests, ladies and gentlemen. I only have, as the chair said, 8 minutes to give my presentation, but I think my job has been made much more easier, maybe a bit harder by my learned colleague Lisa, because I think there's a lot of repetition between what I had planned to say and what she has already said. I think it's not the right presentation. That's yeah, that's it. It's okay. It was not my presentation that was up just now. Okay, great. Okay, so the agenda of my talk is firstly, quick look at the FATF recommendations, 18 and 23, which is applicable for, well, all of the recommendations are applicable to DNFBPs, but for the purpose of my presentation, I'll focus on recommendations 18 and 23. Then we're going to look at over-compliance, which my learned colleague had spoke about at length, so maybe I can go through that a bit more quicker. We'll look at financial exclusion and development risk, challenges in the current AML framework, policy recommendations, and then a conclusion and call to action. Okay, the FATF recommendations for DNFBPs, and DNFBPs stand for designated non-financial businesses and professionals. So that's a category of entities. Typically, AML legislation will refer to them as reporting entities that are required to, amongst other things, provide the authorities with information on financial dealings and transactions. Now, more specifically with regards to lawyers and notaries, FATF recommendations 18 and 23 require lawyers and notaries to apply risk-based AML and CFT measures, conduct customer due diligence, maintain records, at least with several countries, 5 to 7 years, report suspicious transactions in key client activities, appoint a compliance officer and ensure that there are internal controls, implement group-wide AML CFT programs, train staff on AML CFT risk, avoid tipping off clients, and cooperate with regulatory and enforcement authorities. Now, just picture that you have to do all of these tasks as a lawyer and a notary, and you're from the global south, and your law firm basically comprises of just yourself. You don't even have a secretary, as some of the smaller practitioners function. And on top of your workload, you now have to comply with all of these requirements under FATF. So what are the consequences of non-compliance with FATF recommendations? It can be put on the gray or black list at national, individual, or entity level. As mentioned by my learned colleague, could have restricted global restricted access to global financial markets, banking systems, transfer corridors, barriers to financial inclusion, sectoral exclusion from international organization memberships. And FATF clarifies that for standard application that group-wide programs should be proportionate and risk-based, tailored to the structure and risk profile of DNFBPs. It's all very nice words, but we find that in practice, often the local authorities would insist, regardless of what is the exact wording of the law or the recommendations of FATF, you'll find your local authorities may insist that you, instead of applying a risk-based approach, apply a rule-based or prescriptive-based approach, meaning you gather all the information for every single transaction, regardless of the risk involved. I've set out 3 case studies, but in the interest of time, I won't go through all 3 of them. Let's go and look at the middle one in Kenya and what had happened there. As with most of the countries in the global south, a lot of these laws were imposed on us, sometimes with little or no consultation. Typically, the law of a large Western country was just pretty much copy and pasted and applied to a smaller country. And what happens there is how that law is applied in that particular jurisdiction can't be effectively complied with. There might be nuances with that particular jurisdiction. There might be a need for regulations to specify certain thresholds that may not have been done in certain particular jurisdictions. So we find the example in Kenya in 2022 to 2023, where the legal profession did not have clear guidance on filing of STRs, or suspicious transaction reports, and it led to either under-reporting in certain cases and over-reporting or defensive reporting in other cases. And so this is not uncommon in several countries in the global south. And that is that we find ourselves having to abide by laws or regulations that were not tailor-made to our specific and particular circumstances. Which leads me to the topic of overcompliance. So overcompliance is not only about doing more, it's about doing more than necessary, often driven by fear and uncertainty. And the key drivers of overcompliance is that of fear of sanctions and financial exclusion, reputational damage at country risk level or individual or firm level, pressure from correspondent banks and financial channels. We find, for example, like in Seychelles, certain banks are being denied access to correspondent banks, so there can be lots of difficulties with international bank transfers, difficulties in conversion of foreign exchange to particular currencies. There's ambiguity in the FATF guidance, for example, on common ownership, management or compliance control, other technical issues. The desire to retain global financial access and access to aid, and then the desire to meet international benchmarks and standards. Overcompliance in Seychelles. I was going through my old correspondences and noticed an interesting exchange between the Bar Association of Seychelles and members of parliament, which in Seychelles is called the National Assembly. And we were worried about the then AML CFT bill that was being circulated for our comments. And we were worried about over-compliance. And I'll just read out a few of the dialogue or the exchanges in our messages with members of parliament. And we said the executive does not set out the changes required by ISAMLUG. ISAMLUG is another organization that's AML organization that's focused on Eastern and Southern Africa. Instead, they hire a consultant to draft a new law for them, and it is quite clear that the new law was taken from another jurisdiction that probably has larger institutions with greater capacity to implement the measures in this proposed law. Now, why we had said that was that, for example, there was provisions that organizations, reporting entities in particular, had to have a compliance officer and an alternate compliance officer. And like I mentioned, some organizations, some law practitioners practice as sole practitioners, and some of the smaller outfits practice alone. They don't even have a secretary. So how are you going to have a compliance officer and an alternate compliance officer if the number of persons in your organization is one? That was one change that the government actually took into consideration when they made the final act. In the end, they said that you only needed to have an alternate compliance officer if your organization had 15 or more members. I'll continue quoting from our correspondence of 13th February 2020. We said that more bureaucracy and more administrative work for reporting entities, but many of the reporting entities are small outfits without the capacity to implement all of the measures mentioned. It's just impractical. That was in 2020, and it was a little bit prophetic because in 2020, at this point in time, for a small country like Seychelles, for those of you who don't know, the population of Seychelles is just under 100,000. So more than 200 entities have had in some cases, substantial administrative financial penalties levied on them for non-compliance with AML and related laws. This was easily predictable back in 2020 because very small organizations such as charities run by pensioners, for example, they're not even computer literate, who have to go and file all sorts of, or complete all sorts of online databases. They're a charity, they're trying to help the smaller person, and now you levy them with a massive fine because essentially they don't know how to use a computer. Manifestations and structural drivers. The FATF standards are not the sole cause of de-risking, but they contribute to its persistence and exacerbation. The manifestations, for example, are collection of excessive KYC documentation. In some cases, a bank is required to collect all sorts of information on a transaction. The transaction may involve a lawyer. For example, let's say someone's taking a loan from a bank. Now the lawyer is then required to collect the same exact information that the bank had already collected. So how many times are we going to do this process? I think my learned colleague spoke about de-risking and service denial for new or prospective clients. I think my colleague spoke about this at length. So I think I won't repeat myself or repeat what was presented earlier. I'll move on to the next slide. Financial exclusion consequences. So the FATF notes that applying an overly cautious approach to AML CFT safeguards can have unintended consequences of excluding legitimate businesses and consumers from the financial system. So the recommendation from Pavlidis, who's an academic on the topic, is essentially, to paraphrase, proportionate measures should be exercised instead of a prescriptive or rule-based approach.
Mr. Sabino, could you conclude soon? short of time.
Okay, I will sum up, I suppose. I can just sum up this point in time. At the end of the day, what we're trying to say is, we're trying to reach out on is, if you see the first pointer under challenges, one size fits all versus diverse risk realities. I think what I want to emphasize on is that our laws should be specific to a country's needs and a country's requirements, and a one-size-fits-all approach to AML laws should not be the norm. That is all. Thank you.
Thank you, Mr. Sabino. When Mr. Sabino was making the presentation on the recommendations, I was wondering whether there will not be conflict with the professional privilege of lawyers and the breaching of confidentiality of the communication and advice, client communication advice, if the recommendations are fully implemented. Mr. Sabino also flagged the issue of the fear of enforcement agencies amongst some of the persons who are assessing the risk. I think these require consideration. May I now request Mr. Roland Tong, the President of the Law Society of Hong Kong, who has experience also in insurance. He's deeply involved in insurance, so hopefully a different perspective will emerge.
Okay, good afternoon, distinguished guests, members of the legal community. First of all, I would like to take this opportunity to first thank President Kumar and also the Bar Association of the India for inviting me to speak in this very important conference. The topic today is about issues of overcompliance and also financial exclusion in Global South. So the Financial Action Task Force, we call it FATF, describes financial exclusion as the inability of disadvantaged and vulnerable groups, such as low-income individuals, rural populations, and undocumented persons, to access a sufficient range of safe, convenient, and affordable financial services. These groups are often underserved or entirely excluded from the formal financial sector. Individuals with no income and fewer assets often face limitations in accessing financial institutions. Additionally, women, ethnic minorities, disabled individuals, and immigrants tend to experience exclusion from formal credit markets, leading them to depend on expensive finance providers like pawnbrokers or loan sharks. Financial exclusion is a complex issue arising from various barriers, including high account fees, poverty levels, limited access to digital infrastructure, limited financial literacy, lack of trust, and insufficient or inappropriate financial products offered by the providers. Access to regular financial services such as bank accounts and credit facilities is crucial for economic development and social inclusion, particularly as financial systems continue to erode. From an AML compliance standpoint, de-risking is one of the major drivers for financial institutions in the banking sector. De-risking refers to scenarios when banks and financial institutions withdraw services from certain kinds or sectors to avoid regulatory risk. This can make it difficult for individuals, non-profits, and even small business in the Global South to access basic banking services. Without access to banking, these clients may also struggle to pay for or receive funds for legal services, limiting their ability to seek justice, defend their rights, or comply with legal obligations. Legal professionals may find it harder to represent clients who are de-risked or excluded from the financial system, especially in cross-border matters. international transactions, or cases involving NGOs or voluntary groups. The FATF has started paying closer attention to these issues. It has emphasized the importance of using a risk-based approach to client due diligence more broadly and appropriately. FATF has acknowledged that when the risk-based approach is not applied correctly or proportionality, it can prevent people from accessing basic financial services. To support financial inclusion, FATF encouraged the use of simplified customer checks for low-risk products, such as basic bank accounts with limited features. This makes it easier for people with fewer resources or lower financial literacy to access essential banking services without facing unnecessary barriers. However, the FATF's guidelines on the risk-based approach are open to interpretation, as they leave it up to individual countries and financial institutions to assess and apply the level of risk themselves. This is not an easy task, especially for banks that fear regulatory penalties and fines. As such, AML overcompliance can continue to persist, further limiting access to essential financial services. In the legal sector, we also face similar issues. The FATF's strengthened requirements are imposed on lawyers, even though the profession has been identified as a major conduit for money laundering. This disconnect raised serious questions about the proportionality and the long-term implications for legal practice. While AML measures are intended to prevent illicit activity, they often require lawyers to engage more deeply in clients' personal and financial matters, introducing a level of scrutiny that may affect the traditional dynamics of trust and confidentiality in legal relationships. In Hong Kong, AML compliance presents challenges, particularly for small firms and sole practitioners. These groups often struggle when the complexity of regulations and the resources need to meet compliance requirements. In addition, the legal profession in Hong Kong is under increasing pressure to implement a formal AML supervisory framework, an approach that orders law society's role as a self-regulatory body. This is a complex and sensitive task for the law society to balance. While technological advancements such as regulatory technology have significantly streamlined compliance process, their high cost remains a major barrier. Many local law firms simply cannot afford these solutions, which limits their ability to modernize AML practices. The legal sector continues to face challenges in adopting technology at scale due to financial and infrastructural constraints. In contrast, the financial sector is in a much stronger position. With greater resources and regulatory pressure, financial institutions have been able to invest heavily in advanced compliance technologies, resulting in more robust and efficient AML frameworks. Sharing the Hong Kong experience, I would like to begin by noting that while AML compliance remains important, it is no longer seen as a major barrier to accessing financial services by individuals or business. This shift has been driven largely by the rapid advancement of technology, which has been opened up new channels for service delivery. I'm pleased to share that as of last year, Hong Kong became the second most financially inclusive market globally, according to the 2024 Global Financial Index Inclusion Index. Guess what? Today, in my learned friend Lisa, Singapore literally ranked #1. Public sentiment reflects this progress. 90% of the Hong Kong population now feels financially included, with nearly universal bank account ownership. This achievement stems from strategic investment in digital infrastructure, balanced regulation, and regulatory support for a risk-based approach to compliance. From digital banking and mobile payment platforms to AI-driven compliance tools and inclusive product design, innovation has become a key enabler, allowing a broader segment of the population to access financial services more easily and securely. This is particularly important for individuals and business who face structural barriers to traditional banking, such as low-income individuals, small and medium-sized enterprise, and new startups, who may struggle to provide the documentation typically required to open traditional bank accounts or have wider access to financial services. The Hong Kong Monetary Authority, which oversees banking regulation, has provided clear policy guidance to support this transformation. It consistently reminds banks to apply a risk-based approach to customer due diligence, urging them to avoid unnecessary procedures and reject the use of one-size-fits-all model when assessing account opening applications. This approach helps ensure that compliance does not become a barrier to financial access. A good example of this is the Simple Bank Account initiative, introduced by banks with the support of the HKMA. The SBAs offer basic banking accounts for companies, which allow banks to apply simplified account due diligence measures under a risk-based approach. Since its launch in 2019, the Simple Bank Account initiative has led to the opening of approximately 13,000 accounts, averaging around 3,000 new accounts per year. This demonstrates the effectiveness of tailored compliance in improving access to banking services for small or lower risk entities. One of the most transformative developments has been the rise of virtual banks. Hong Kong now has 8 digital-only institutions licensed by the Hong Kong Monetary Authority. They leverage advanced tools such as the algorithmic Know Your Customer, KYC, AI-powered risk assessment, transaction monitoring, and biometric verification. Through the use of electronic KYC systems and a digital government platform such as IAM Smart, residents in Hong Kong, including those in remote areas, can now open bank accounts and conduct transactions without needing to visit a physical branch. These innovations have streamlined client onboarding and significantly reduced operational costs, making it more sustainable for the financial institution to serve a wider range of clients. Another key driver for financial inclusion is fintech. Digital tools like mobile banking, e-wallets, and payment solutions have made financial service more accessible, especially for the individual living in excluded or rural parts. Mobile payments, in particular, have become essential for fast, secure, and inclusive transactions. Today, small business owners and entrepreneurs can apply for loans, manage payments, and access insurance directly through apps without relying on traditional banking. In conclusion, despite technological progress, financial inclusion faces key challenges, such as no financial literacy, access to technology for some jurisdictions, and lack of trust in digital systems. Addressing these issues requires continued investment in education and adaptive and proportionate regulations to ensure technology serves all segments of society. Also, further clarity and guidance regarding AML, counter-terrorist threat requirements, CFT, and the implementation of the risk-based approach for clients classified as high risk is needed. In this regard, the FATF needs to collaborate and coordinate with countries and also different sectors. It is important to incorporate these principles into the FATF's mutual evaluation methodology, ensuring that the implementation of the risk-based approach in line with FATF standards does not exaggerate de-risking. Lastly, the legal profession has a critical role in advocating for a balanced risk-based approach or to AML compliance that protects both the integrity of the financial system and the rights of clients. Lawyers and bar associations can contribute to policy discussions, challenge overboard regulations, and promote guidance that prevents financial exclusion and protects access to justice. Thank you.
Thank you, Mr. Tong, for highlighting the need for protection of financial integrity and the client's right, human rights, I think we have some time.
Friends, we were running 45 minutes late into the lunch. Now we are in a deficit of 11 minutes only. So we have covered quite a long time through efficiency of this session. So what I'll request is to have a very quick tea break, and this time tea is ready outside. So please enjoy that and come back within 10 minutes.
Good.